I need you to stop what you're doing and pay very close attention to what I'm about to tell you, because there is a setup forming right now that could crash silver 15% or more. Tomorrow, Friday, less than 24 hours from when I am recording this video. And if you are not prepared, if you are holding leveraged positions, if you are trading on margin, if you are not aware of what is coming, you could wake up Saturday morning to find a significant portion of your wealth has evaporated. I'm not saying this will definitely happen. I'm saying the conditions are in place. The warning signs are flashing. The historical patterns are aligning, and the specific events scheduled for tomorrow create a perfect storm that could trigger the kind of crash we saw on January 31st when silver dropped 31% in a single day. I have been analyzing silver markets for years. I've studied every major crash. I've identified the patterns that precede them. And what I am seeing right now is setting off every alarm bell I have. The setup is textbook. The vulnerability is extreme. And most silver investors have no idea what is about to hit them. Welcome back. If this is your first time here, subscribe immediately to Smart Fination, because this video could save your portfolio. By the end of this video, you're going to understand exactly why tomorrow is so dangerous, the 5 specific factors, creating crash risk, what happened in previous Friday massacres, how to identify if the crash is happening, and exactly what to do to protect yourself in the next 24 hours. Let me start by explaining why Friday is historically the most dangerous day for silver. Because this is not random fear-mongering, this is documented statistical fact. When you analyze every major silver crash over the past 50 years, an unmistakable pattern emerges. A disproportionate number of crashes occur on Fridays. January 31st, 2026, when silver crashed 31%, was a Friday. April 25th, 2011, when silver began its crash from $49 to $26, was a Friday. March 14th to date, when silver dropped 15% in a single session, was a Friday. Silver Thursday, the infamous Hunt Brothers crash on March 27th, 1980, that triggered the end of their corner, and was a Thursday that extended into Friday. Why Fridays? Several structural reasons. First, Friday is options expiration for weekly options. Market makers who have sold options have maximum incentive to move prices on expiration day to make those options expire worthless. If there is significant open interest at certain strike prices, market makers will do whatever is necessary to ensure price closes below call strikes and above put strikes. This creates artificial volatility concentrated on Fridays. Second, Friday afternoon has the lowest liquidity of the week. Many traders close positions before the weekend. Trading desks operate with skeleton crews. Liquidity providers pull back. In this thin market, large orders have outsized impact on prices. A sell order that might move silver $0.50 on a Tuesday could move it 5% on a Friday afternoon. Third, the weekend creates uncertainty risk. Markets are closed for 60 hours. Anything can happen. Geopolitical events, policy announcements, natural disasters. Traders do not want to hold risk over a weekend when they cannot react, so they sell on Friday. The selling pressure is predictable and exploitable. Fourth, Friday is when bad news is released. Companies announce disappointing earnings after Friday close. Governments release embarrassing data on Friday afternoon, hoping it gets buried over the weekend. The phrase Friday news dump exists for a reason. Silver, as a risk-sensitive asset, reacts negatively to bad news. Fifth, margin calls from weekly options and future settlement hit on Friday. Traders who have been fighting losing positions all week finally face the margin clerk on Friday. If they cannot meet the call, they are liquidated. Forced selling hits the market. Prices drop, more margin calls trigger. The cascade begins. These structural factors make every Friday dangerous, but tomorrow is not just any Friday. Tomorrow has 5 specific catalysts that dramatically increase crash risk. Catalyst number 1, February options expiration. Tomorrow is the February monthly options expiration for COMEX silver. This is not just weekly options. This is the big monthly expiration where billions of dollars in open interest will be settled. The battle between bulls and bears will be intense. Looking at the current open interest, the $85 strike has massive call open interest of approximately 18,400 contracts. The $90 strike has significant call open interest of approximately 12,300 contracts. The $95 strike has substantial put open interest that was established during the recent rally. For market makers, the ideal scenario tomorrow is silver closing between $85 and $90. That would make the $90 and $95 calls expire worthless, while the $85 puts also expire worthless. Maximum premium collected, minimum payout. But here's the problem. Silver is currently trading at $97. It is above all the major call strikes. Market makers who sold those calls are facing delivery obligations on potentially 150 million ounces of silver. They do not have 150 million ounces. They do not want to deliver. They want to push price back below $95, ideally below $90 before expiration. They have approximately 18 hours to accomplish this, and they have the tools to do it. Coordinated selling, spoofing, spreading negative narratives, triggering stop losses. Everything in their playbook will be deployed tomorrow to push silver lower before the expiration deadline. A crash from $97 to $85 is a 12.4% decline. Add some panic selling and momentum acceleration, and 15% is easily achievable. Catalyst number 2, CME margin review announcement expected. My sources indicate that the CME is conducting its regular margin review, and an announcement could come as early as tomorrow afternoon. After the extreme volatility we have witnessed with silver moving from $68 to $97 in 2 weeks, a margin increase is almost certain. The CME raised margins 37% on January 30th. That triggered the January 31st crash. If they announce another margin increase tomorrow, history could repeat. Leverage longs who cannot meet the higher margin requirements will be forced to liquidate. The selling will cascade. The CME typically announces margin changes after the close on Friday, effective the following Monday. But sometimes they announce during trading hours. If a margin increase is announced at 2 p.m. Eastern tomorrow, while the market is still open, the reaction will be immediate and violent. Traders who remember January 31st will not wait to see if they can meet the margin call. They will sell first and ask questions later. The PTSD from the last margin hike is fresh. Fear will dominate rational calculation. Catalyst number 3, Federal Reserve Governor speech at 10 a.m. Federal Reserve Governor Christopher Waller is scheduled to speak at 10 a.m. Eastern tomorrow at an economics conference. His remarks will be closely watched for signals about monetary policy. The market has been pricing in rate cuts based on recent dovish comments. If Waller strikes a hawkish tone, if he suggests rate cuts are not imminent, if he emphasizes inflation concerns over growth concerns, the market will react negatively, the dollar will strengthen, precious metals will weaken. Silver is particularly sensitive to Fed commentary because it sits at the intersection of monetary metal and industrial commodity. Hawkish Fed policy hurts silver on both dimensions. It strengthens the dollar, making silver more expensive for international buyers, and it threatens economic growth, reducing industrial demand. A single hawkish sentence from Waller at 10 a.m. could trigger a 3% to 5% drop in silver within minutes. Combine that with the other catalysts, and the drop accelerates. Catalyst number 4, commitment of traders. Report release at 3:30 p.m. The CFTC releases the weekly commitment of traders report every Friday at 3:30 p.m. Eastern. This report shows the positioning of different categories of traders as of the previous Tuesday. Based on the price action this week, the upcoming COT report will likely show that managed money, the hedge funds, have dramatically increased their net long position. Commercial traders, the banks, have likely increased their net short position to match. When the report comes out, showing extreme positioning, algorithmic traders will react. Historically, extreme managed money long positions are followed by price declines. The algos know this pattern. When they see extreme positioning, they sell. The report released at 3:30 p.m., right before the weekend close, could trigger a wave of selling. Traders will see the extreme positioning and want to reduce risk before the weekend. Selling begins. More selling. The thin Friday afternoon market amplifies every move. Catalyst number 5, quadruple witching spillover effects. Tomorrow is not just silver options expiration. It is quadruple witching in the broader equity markets. Stock index futures, stock index options, stock options, and single stock futures all expire simultaneously. This creates chaos across all markets. During quadruple witching, correlation across asset classes increases. Forced selling in equities spills over into commodities. Margin calls in one market require liquidation in other markets. The interconnected plumbing of modern finance means stress anywhere becomes stress everywhere. If the equity market has a bad day tomorrow, and quadruple witching days are often volatile, that stress will transmit to silver. Traders who need to raise cash will sell their most liquid positions, including silver ETFs and futures. The contagion effect is real and predictable. Now, let me show you what previous Friday massacres look like, so you can recognize the pattern if it begins tomorrow. The January 31st, 2026 crash started slowly. In the Asian session, silver was down 2%. Nothing alarming. By the European Open, it was down 5%. Concerning but not panic-inducing. By the US Open, it was down 12%. Serious pain, but still orderly. And then between 1 p.m. and 3 p.m. Eastern, silver crashed another 19%. The final 2 hours accounted for more than half the total decline. This pattern is typical of Friday crashes. They start slowly as selling absorbs buying. They accelerate through the European session as more sellers appear, and they climax in the US afternoon when liquidity disappears and forced liquidation dominates. If tomorrow follows this pattern, here is what you should watch for. Warning sign 1. Asian session weakness. If silver is down more than 1% during Asian trading tonight, that is the first warning. The night session is usually quiet. Significant selling during that period suggests large players are positioning for what comes next. Warning sign 2. Gap down at European Open. If silver gaps lower when London opens at 3 a.m. Eastern, that is serious. Gaps indicate urgent selling that cannot wait for orderly execution. A gap down of more than $1 is a major red flag. Warning sign 3. Failure to bounce after Waller speaks. If Waller's speech at 10 a.m. causes silver to drop, and it does not bounce within an hour, that is trouble. Normally, knee-jerk reactions to Fed speakers are partially reversed, as the market digests the comments. If there's no reversal, it means the selling is not just about Waller. It is something bigger. Warning sign 4. Volume spike after 1 p.m. Watch the volume. If volume starts spiking after 1 p.m. with price falling, that is the cascade beginning. High volume on the downside means forced selling, margin calls being executed, stop losses triggering, the death spiral starting. Warning sign 5. Premium collapse. If you check dealer websites and see premiums on physical silver declining during a price crash, that is unusual and concerning. Normally, premiums hold or increase during crashes as physical buyers step in. If premiums collapse, it means even physical buyers are stepping back. Fear is absolute. Now let me tell you exactly what you should do in the next 24 hours to protect yourself. Protection strategy. 1. Reduce leverage immediately. If you are trading silver on margin, if you're holding futures contracts, if you have options positions, reduce your exposure today. Do not wait for tomorrow. Do not tell yourself it will probably be fine. The risk reward of holding leverage positions into tomorrow is terrible. The potential downside is massive. The upside of one more day of holding is minimal. Sell half your leverage position today. If tomorrow is fine, you still have exposure and you can re-enter Monday. If tomorrow is a massacre, you have protected half your capital. This is basic risk management. Do it. Protection strategy. 2. Set stop losses below key support levels. If you are holding positions and choose not to reduce them, at least protect yourself with stop losses. The key support levels to watch are $92, which is the first major support from recent consolidation. Below that is $88, which is the secondary support from the rally base. And below that is $85, which is the critical support that has been tested multiple times. Set your stop loss at whatever level represents the maximum loss you are willing to accept. Do not set it too tight, or you will be stopped out by normal volatility, but do not set it so wide that a 15% crash wipes you out. Protection strategy. 3. Have cash ready to deploy. If the crash happens, it will be a buying opportunity. The fundamentals have not changed. The supply deficit is still real. The industrial demand is still growing. A 15% crash caused by options. Expiration mechanics and margin call cascades does not change the long-term thesis. Have cash ready. Know what you want to buy. If silver crashes to $85 tomorrow, be prepared to back up the truck on Monday when the panic subsides. The same silver that was worth buying at $85 2 weeks ago is still worth buying at $85. Protection strategy. 4. Do not watch the screen. If you have followed strategies 1 through 3, you have protected yourself. Now step away. Do not sit there watching every tick. Do not torture yourself with the decline. Do not make emotional decisions based on moment-to-moment price action. Friday afternoon is the worst time to make trading decisions. You're tired from the week, liquidity is low, prices are chaotic, emotions are running high. Any decision you make during a Friday afternoon crash is likely to be wrong. Make your decisions now while you're calm, and then step away. Protection strategy. 5. Remember the long-term thesis. Whatever happens tomorrow, the fundamental case for silver remains intact. The supply deficit is 100 million ounces per year. COMEX inventory is at historic lows. China has restricted exports. The U.S. has declared silver a critical mineral. Industrial demand from solar and EVs is exploding. A 15% crash tomorrow does not change any of that. It is noise. It is manipulation. It is options games and margin calls. It is not fundamental. Do not let short-term price action shake you out of a long-term position that is based on solid analysis. Now, let me address the possibility that I am wrong because I want to be intellectually honest. There is a scenario where tomorrow is fine, where the options expire without drama, where Waller says nothing surprising, where the margin review is delayed, where quadruple witching passes without contagion, and where silver closes Friday slightly higher than it opened. This scenario is possible, maybe even probable. The most likely outcome on any given day is that nothing dramatic happens. That is how markets work most of the time. The crashes are exceptions, not the rule. But the exceptions are what destroy portfolios. The exceptions are what turn profitable years into devastating losses. The exceptions are what most people are unprepared for because they focus on the probable and ignore the possible. My job is to warn you about the possible. My job is to help you prepare for the scenarios that others are not considering. My job is to make sure that if tomorrow is a massacre, you are not among the victims. If tomorrow passes without incident, you can criticize me for being too cautious. You can say I was fear-mongering. You can say I made you unnecessarily anxious. I accept that criticism. Being wrong about a warning is far better than being right about a warning that nobody heeded. But if tomorrow is a massacre, if silver crashes 15% and you were prepared because you watched this video, then I will have done my job. I will have provided value. I will have helped you protect your wealth. The asymmetry is clear. The cost of preparing for a crash that does not happen is minimal. Some missed opportunity cost, some psychological discomfort. The cost of not preparing for a crash that does happen is potentially catastrophic. Massive losses, margin calls, forced liquidation at the worst possible prices. Given that asymmetry, preparation is the only rational choice. Let me close with a summary of the key points. Tomorrow, Friday, has 5 specific catalysts that create elevated crash risk. February options expiration, where market makers want price below $90. Potential CME margin hike announcement. Fed Governor Waller's speech at 10:01 a.m. COT report released at 3:30 p.m. And quadruple witching spillover effects. These catalysts are converging on a day that is historically dangerous for silver. The thin liquidity of Friday afternoon amplifies every move. The weekend uncertainty makes traders reluctant to hold risk. Protect yourself by reducing leverage, setting stop losses, having cash ready to deploy, avoiding emotional decisions, and remembering the long-term thesis. The crash may not happen, but if it does, you will be prepared. And in markets, preparation is the difference between survival and devastation. Subscribe to Smart Fination. Drop a comment and tell me how you are preparing for tomorrow. I want to know your strategy. I read every single comment, and I will see you in the next video.